let's move on. We were talking about mutual funds last time. So mutual funds are a way for small investors to get a lot of diversification without a lot of money. If you only have $3,000-$4,000, you can buy thousands of stocks all at once just by investing in a fund. You buy the NAV, which is the net asset value at the end of the day. You get fractional shares. So the nice thing is you can just say, hey, I want to buy $5,000 worth, and they might give you 100 shares, 0.2367, something like that. The NAV struck every day, usually around 5 or 6 o'clock. Using my mutual funds around 6:30 at San Antonio time, I have the price. So the markets close at 3 o'clock, and then they have to stay there. The accountants are all there at the end of the day, and they have to strike that NAV, and they have to get it right. I remember one day sitting at my desk, I watched all my mutual funds, and I saw one that the price made no sense to me at all. So there's some error somewhere. So I called the accounting people. There's something wrong with your NAV. There's no way my fund did that. Sure enough, they found an error. They all had to come back in, work really late that night to fix it. But they were glad I found it, because they hadn't found it. And the next day, if they had done trades, they'd send people money, or they invest people's money, especially sending money out. They're never going to see that again unless they made a mistake, and made a mistake, they had to fix it. But they overdid it. So they were glad I made them stay up so late, because if I hadn't, the next day their overtime would have been massive. It would have been terrible. So I watched my NAVs really closely. So you can always get out of NAV. Now there are rules that says while you'll get out at today's NAV, no question, you may not get your cash as fast as you like. So they can't have rules on how much you can, they can limit how much you can take out. So what I discovered with my mutual fund, I want to take a large amount out at one time, and they said you have to call in to do that. It's like, give me a break. But why did they do that? They're trying to discourage you from taking your money. You think they have to call in to put a lot of money in? No, you can do that anytime you want to. But if I want to take money out, maybe it's good for me, because if someone's fraudulently using my account and doing something, maybe it protects me some. I don't know. But I had to call in, and they're like, sure, we'll do it. So they made it easy, but I don't want to make a phone call. So very good for small investors to get good diversification, and you can hire really good managers. The best managers in the world are managing these funds. You can certainly do that. The downside is you can only trade once a day. So we saw last Thursday, I guess I messed up last Thursday. I said the market didn't fall that much, but it came back, but it actually fallen quite a bit. That was a pretty big day. It was down 2%. It ended up 2%. And then Friday it reversed, and then Monday it reversed. Today it looks like we got 2 days in a row, although it was coming off a little bit there. So we had a 2-something data yesterday and a 1% today, positive. What's the market telling us? The 10-year is still above 4, isn't it? Still right at 401, the first time in 14 years or whatever, a long time, 12 years, 10 years. I guess 12 years. So the market's telling us something. It seems to be saying, it was bad, but we've gone as bad as we're going to go. We're going to start coming back, but could that reverse again? Yeah, who knows? But if you have that view and you want to trade during the day, you can't do that with a mutual fund. You can only trade at the end of the day.
One transaction is total, either buy or sell.
Right? Yeah.
You can't do one of each.
And you can't.
Buying.
You really can't do 2 transactions. So if you do $10,000 at 2 o'clock, you say, no, I want to do 15,000. You essentially would cancel the 10 and redo the 15. Now you do have the right to cancel it up until 2:59:59. You better do it really fast, because it may take a second to get there. But if it gets there at 3 o'clock in 1 second, you can't undo it. You're stuck. So it's very sensitive. Well, the same thing with stock trades and everything else. Once 3 o'clock hits, you can't do anything. Now they don't do your trade at 3 o'clock. It takes them several hours to do all the paperwork. But yeah, once 3 o'clock hits, you're out. Now, there are other type of mutual fund accounts for bigger investors. So a commingled account is like a mutual fund for a really large investor. So a commingled account doesn't have a ticker like a mutual fund. You can't trade, but it looks like a mutual fund. But you get to put your money in, and it somewhat protects you from small investors. So A mutual, JP Morgan, Goldman Sachs, they may have commingled accounts for their largest investors. And what it does is they have more restrictions what you do, what you can put money in and take money out. So a commingled account is essentially, it can be a separate account. So there's a difference between a commingled account and a separate account. My notes don't explain it very well. So a commingled account is a big fund where multiple investors in there, but it may only be 20 or 30 investors, and they each have 40, 50, 100, $200 million in there. A separate account is when I go to JP Morgan and say, hey, I really like this investment strategy, but I want to be the only investor. So a separate account is when you're the only one and they manage the money for you. And it may be cheaper, you have more control, you don't have to worry about other investors taking their money out at the wrong time. So that's a commingled account. So usually commingled accounts, they may have a minimum of 10 million, 50 million, 100 million. I remember one day I had to call Deutsche Bank because I wanted to put some money into an index fund. And I couldn't remember my contact's name. So I just called 1-800 number. And I said, I need to do 340. He goes, 340,000. I said, no, 340 million. He goes, oh, just a second. So he had to go find. But then I met this guy later. I actually contacted a pretty impressive guy at Deutsche Bank, met him later. But he wasn't expecting someone to come through their 1-800 line and do 340 million. I just couldn't find my contact's phone number. So that would have been better placed in a commingled account because I get lower fees, I have more control over the money. So a mutual fund might charge 0.7%, a commingled account might charge 0.3%, and a separate account might charge 0.1%. You just get lower fees because you have more control and you have more money in there. Well, the nice thing we have now are these exchange traded funds, which is probably what most of you are doing. I tend to do mutual funds on the bond side, but do exchange traded funds. So what's an exchange traded fund? It's just a mutual fund, but trades like a stock. You can trade intraday. It has tickers. Looks a lot like a stock, but it's a mutual fund. So when you go into them, you're in there with a bunch of other investors. You get a lot of diversification. You can get better control over your taxing gains and losses. When I first saw that comment, I didn't believe it, but I've since become convinced, but I can't remember why I became convinced. So I need to go research that again. But ETFs do give you better control over gains and losses than mutual funds. So there's one advantage there. You have to watch the fees, but they tend to have comparable fees to mutual funds. So let's see, Vanguard. Vanguard has both mutual funds and ETFs. They probably have the exact same fees. Fidelity, US Victory Capital, they have both. They tend to have the exact same fees. You just have the advantage of that you can trade intraday. I like what Vanguard did. I thought it was pretty smart. So most funds, when they start an ETF, they have to start an entire separate fund. And so you have this mutual fund that has $1 billion in it. You want to start an ETF that looks the same way, where you start with zero. What we had to do at UTSA is they came to us on the parent company side and begged for money. Could y'all like throw 50 million into this fund just so we can get it started? So yeah, sure, you have to do that. We didn't like doing it because it messed up our strategy. But what Vanguard discovered was their ETFs weren't a separate fund. When you bought a Vanguard ETF, you're actually buying an ETF of their mutual fund. So you were just buying their mutual fund, but as an ETF. And that was really, I think, a smart way to do it because they didn't have to set up anything separately. ETFs are very, very inexpensive ways to buy stocks. They're a really liquid way to buy stocks. You have to watch out for one thing on the very esoteric ones. There's some thought that these things could really blow up, especially if you're doing things like oil funds or commodity funds. How is a gold ETF investing? So you want to buy gold, but you don't have to buy gold. So you buy a gold ETF. Well, the gold ETF probably doesn't buy gold either. They're probably buying gold futures and gold swaps. We have to be real careful what they're actually buying, because if they're buying swaps, swaps are a very dangerous vehicle because a swap can go default. So it's possible you could be buying a gold ETF and you think you're going to get gold. Gold prices shoot up, but the ETF has a swap that's with Lehman Brothers or somebody, it goes insolvent, and suddenly your ETF doesn't go up, it goes out of business. So you got to be real careful. So you want to know what they're actually owning. So with an ETF, you want to look and see all the securities they have. If you see swap accounts, you want to be really concerned because those can be really, really dangerous. Not that all of them do that. Most of them don't, but the ones that do, you want to be really careful on that. So if you're doing something a little bizarre, I would look in detail what they're doing. Right. Questions on exchange traded funds. They're taking over the world. If you look at any chart, mutual funds are coming down, ETFs are going up. So they're really taking over the world. There's also actively managed ETFs instead of just indexed. So you can get all kinds of strategies. We'll talk about a few of them here. Do y'all have ETFs? Any of y'all? Any of y'all bought ETFs before? They're pretty easy to buy, probably on almost anything now. It's getting kind of crazy. All right, 401k plan. This is you're gonna be doing this, aren't you? Or 403b, depending on what if you're in a for-profit, you'll do a 401k. If you're a charity or a university, 403b. These are essentially commingled accounts. They can be mutual funds. They're probably not going to be ETFs, but so they're either mutual funds or commingled accounts. Your employer sets it up for you, and you put your retirement in there. Why would you do this? Well, first, your employer might match. When I left USAA, I think they're matching 8%. I don't know if that's still the case, but that's pretty good. You can put 8% in and they'll put 8% in. You're essentially doubling your money. That's pretty impressive. Now, the reason they went to 8% is it was 6% when I started, but it was 6% 401k plus they had a pension plan. And then they killed the pension plan and they gave an extra 2% on the 401k plan, which I thought was a really bad idea. But anyway, I lost that argument. So most of y'all will do the 401k. How much should you do? If your employer matches 8%, how much should you put in? You should put in 8%. If you don't, you're throwing away money. It just doesn't make sense not to do that. But what's the advantage of a 401k? Well, the IRS giveth and the IRS taketh away. So in the 401k, what do they give you? You get to invest with pre-tax dollars. So you get to put in money before the IRS takes money out. So you're investing more money. You get it tax deferred. You don't have to pay any tax until when? At some age, 70 or whatever, 70 and a half, there's some age where the IRS says you have to start taking the money out. And it's 100% taxable, and it's taxable as ordinary income. So you don't get the advantages of capital gain taxes and all that. So in the future, you're going to be taxed on it. But today, you get double tax advantage. Now, how does that compare to a Roth IRA? Y'all know a Roth IRA? So a Roth IRA, you have to buy with after-tax dollars today. You get the tax deferral, but then it's never taxed. There are Roth 401k plans. So a Roth 401k plan, what they do, you have to buy it, you get it with after-tax dollars, but then it's tax deferred and never taxed. So you might check with your employer, see if they have a Roth 401k. That might be the better. So what's the better one to do? Well, most people say the Roth is better, but we really don't know. And why don't we know? You can run all kinds of models, but the one thing you can't model is the US Congress. Are Roth IRAs tax-free? Yes, unless what? Congress changes the rules. Well, a country with massive debt that's getting no smaller have any incentive to maybe make Roth IRAs taxable in the future? Yeah, they have that incentive to do that. Remember, Social Security used to be tax-free. Now they tax it. So, they can change the rules at any time they want to. And what are they going to do? Well, how do you manage a massive debt of a federal government? You tax the most responsible citizens because why? They're the only ones with money. You're not going to tax the irresponsible ones because they don't have any money. It's like, yeah, take all you can. I don't have anything. I didn't save for retirement. I spent it all. I was buying jet skis when I should have been saving for retirement. But yeah, what are you going to do? So if you're really diligent and you save up, you have a wonderful Roth IRA, you're the person the IRS is going to come after because you have money. So I don't know how to plan that. But assuming Congress never changes the rule, assuming normal stock markets, the Roth 401k might be the better deal, and you should probably load that up with your stocks. That's the general thought, but who knows? What if your firm bundles its 401k plan? So bundling. I had this debate at USA. I almost lost my job on this one. I was prepared to fall. This was my fall on the sword. USA wanted to bundle its 401k plan. I fought so hard, so much that the head of human resources, she was so mad at me. She said, I'll still run. We're going to have a vote on it. And I went in there ready to fight. I was this peon. I was a VP, all these senior vice presidents in there. I think it was an AVP. I was even more of a peon, an AVP, and all these senior vice presidents. She brings it up. I'm ready to fight. And the president of the investment company said, why would we ever do that? I was like, whew. And they killed the whole thing. We never talked about it again. I was saved by the president of the investment company. But what is bundling? So bundling is when your employer says, you know what? We got to find a way to rip off our employees. And I think we found it. And that's what it is. If your firm bundles, they're ripping you off and they should be sued and you should fight it. So what is bundling? Your employer provides you this really nice plan, but it has a cost. It's called record keeping. Record keeping is a few $100,000 a year. Your employer is paying for that. They don't like to pay for that, but it's a cost of doing business. And they say, what if we could get record keeping for free? That sounds good, doesn't it? Let's go to Fidelity and we'll pay them for record keeping, but hey, they'll give it to us for free. Why would they give your company record keeping for free? Well, what Fidelity says is, hey, instead of you paying us $300,000 for record keeping, you give us all your employees' money and we'll invest it in funds and we'll overcharge them. We'll make an extra $1 million, but we won't charge you the $300,000. Who wins in that game? Your employer wins. They save $300,000. What does Fidelity do? They win. They make an extra $700,000. Who's the only loser in this? The employees. So maybe the employer doesn't want to pay you $300,000, so they make you pay for that. They can't do that. But instead of making you pay the $300,000, they instead lose you $700,000, $1 million. You're $1 million worse off. You're $1 million worse off. Your employees $300,000 better off. Fidelity $700,000 better off. I think it should be illegal. I don't think people should be able to do that. The federal government has talked about it, and they haven't had the guts to do it. Why? Because the industry makes so much money off of this. I fought it twice. Times I had to fight this. It was funny. A guy from Dial came to USA. I forget his name. I probably shouldn't put it on the video anyway. He came in. He was kind of I don't know. I won't say the word, but he was kind of one of those people. And he came in. You guys are so stupid. You're paying record keeping. Nobody pays record keeping. And I explained to him what record keeping. At the end of it, he was quite embarrassed that he had harmed his employees. He had no idea how much harm he was doing his employees. So how do you know if your firm's bundling? Send me your plan and I'll tell you, because you can tell pretty quickly based on the fees they're charging. So at USA, we had a mutual fund. We had a 401k plan. It was the S&P 500 index fund. It charged 1 basis point. It was almost free. That's what I would say. Let's get it to our employees and get it to them cheap. It's their money. We shouldn't be charging all these fees. You don't want your firm to be creating a 401k plan that makes the industry money. That's not the purpose of it. The purpose of it is for you to retire and build your retirement. So be really careful on that. Okay, let's talk ETFs. I forget where I put them in here somewhere. I can't remember where I put them though. I'm pretty sure. Let's talk. So who are the major ETF providers? Well, exchange traded funds started off as index funds put into an ETF. So much of them are passive index funds. So the biggest providers of ETF are going to be the big index providers. And who are those? The 3 biggest index providers. Can y'all name them? They're the biggest firms out there. So, Fidelity probably isn't. I don't know. I'd have to look. I'm sure they do ETFs. What's the largest firm in the world? BlackRock. Yeah. So they have big ones. That's the iShares. Y'all heard of iShares? Who's the second largest firm out there? Vanguard. What do they have? They have Vipers. And then the third largest index manager out there is State Street. Have you ever heard of State Street? Have you ever heard of Spiders? All right. So So I think Vanguard did Vipers because Vipers eat spiders. So I think that's the reason they did that. So those are the biggest ones. So iShares, that's BlackRock. There's the Spider. It's not actually Spider, but it's SPDR. But if you've seen their, have y'all seen their commercial? It's a spider lifting weights. Have y'all seen that? So I'm not sure how they came up with that. And then Vanguard. Those are the three largest. So you got iShares, Vipers, and Spiders. I've never bought a Viper from Vanguard. I tend to use the SPY, which is the iShare. But they're out there. You can do all of those. And then you have some of the exotic ones. I can't spell exotic. So these guys, I think I have them listed in the class notes. I thought I had them in my, so these guys have gotten a little bit too creative, but it's interesting what you can do. Forensic accounting ETF. Insider sentiment ETF. I don't know if you want to go with Swiss. There's a hedge fund ETF. But I'm trying to think of the name. I wish it was in the notes. Maybe I have to show you next class. But we have ETFs now that are doing things like sorting the S&P 500. So you can buy a -2 times the S&P 500. What that means is if the S&P 500 is down 5%, they'll be up 10%. That's pretty crazy, isn't it? Just incredibly overly creative. They have short treasury markets. I bought that ETF when the 10-year treasury hit 0.5%. I shorted the long treasury, thinking we're just at the bottom. That thing's up almost over 40%. What is that is when interest rates rise, it actually goes up in price. You know, bonds fall when interest rates rise. This one, bond prices rise when interest rates rise. So that's an interesting negative duration bond fund. You can have a 3x S&P 500. So if the S&P 500 is up 5%, it's going to be up 15%. So crazy, crazy stuff. You have to wonder, how are they doing that? They're going to do it with derivatives, options and futures and those type of things. They have to. So you got to be real careful. They're doing some pretty wild stuff. They better know what they're doing. Let me, I think I can find one here. Let's see if we can find ProShares, I think is ones. ProShare ETFs. They even have Bitcoin strategies. So ProShares, our ETFs, Bitcoin linked. If you want to do Bitcoin, maybe they have a 2 times Bitcoin. I doubt they have that, but that's possibly. They do have interest rate hedged ones. So you have negative interest rate ones so that they rise when interest rates rise. They have rising factor alternative volatility ones. It's really crazy how they have these things. The short VIX. So if you think the VIX is going to rise, you can buy this one and it'll make money when the VIX rises. When does the VIX rise? When the stock markets crash, when there's a lot of risk. This would probably do better than a gold fund in a crisis, because we've seen gold this year has not done well when inflation's up. So here's one. They have the Ultra VIX. So what does that mean? That's gonna, you know, just leverage it up. So ProShares is an interesting one. I want to find the let's see if we can find volatility doing X fixed rising rates theme. I'm not finding the ones I'm thinking of, but they have some really interesting ones. Somebody in their firm is sitting around thinking of stuff. They can't do it if there's not a market. So they have to find someone that's interested in this. Obviously, people are worried about markets falling and markets rising, so they got to think about that. But they give the S&P 500, but would you want something like that on small caps? Would you want something like that just on utility stocks? Would you want a Bitcoin fund that would make you money if Bitcoin fell? You say, yeah, well, how would you create that? How do you short Bitcoins? Is it even possible? So you have to ask, how are they actually created? So the VIX is a really interesting one. How do you create something that's going to go up in value when the VIX goes up? How do you buy the VIX? The VIX isn't anything. So you have to create it with using options and future, just strange things. So you really have to wonder how exactly are they doing this? So it's, there's almost too many people cooking these things up. But you might experiment with it. So let me blow your mind. We're going to do options later in this class. ETFs have options. If you don't know what an option is, we'll talk about it later, but an option is the right to buy something at a price at a future time. Let's say you have an ETF that shorts the market. It's a 2x the market negative. So if the S&P falls 5%, you're up 10%. You can buy options on that ETF. What is a call option on an ETF that's minus 2x the S&P 500? Isn't that crazy? This is absolute insanity. So you buy call options on the S&P when you think the market's going up, but now you can buy call options on a negative ETF because you think the market's going to fall. It's crazy, crazy stuff. So, we're getting a little too sophisticated, I think. But anyway, would you want to work for a firm like that? It sounds like it'd be pretty exciting. In product development in a firm like that, because you'd have to have a few things. First of all, is there demand for this product? Secondly, can we actually create it? Can we create it? Because some of these VIX funds, I should show you some of these VIX funds. Some of these VIX funds, the VIX went from 20 to 80. So the VIX was up 400%, and these funds are up like 30%. Would you be a little upset when you bought something that was supposed to be up 40%, 400%, it was only up 30%? Would that make you a little bit upset? I would be a little upset about that. So they're not doing a good job on some of them of creating this. So be careful, buyer beware, but there's some interesting things going on. All right, so active versus passive investing. We talked a little bit about this before. If you're trying to beat the market, you want to be active. So if the S&P 500 or large cap, its beta is 1. If it's up 4.2% to beat the market, you got to make more than 4.2% after fees. And that's called your alpha. Have y'all heard alpha before? So beta is the market. So your beta is the 4.2%. Your alpha is how much you make over the market, and that includes fees. So your alpha is your excess return. Can alpha be negative? Yeah. If the market's up 5%, you're up 3%, your alpha is negative 2%. Alpha can be negative. I used to have a t-shirt. I used to wear it all the time. It said, "Alpha is life." Great t-shirt. I got it from a hedge fund. The hedge fund went bust because of fraud. So I don't wear the shirt so much anymore. But at the time, it was a pretty cool shirt. Why do they say alpha is life? Because that's what they do. They add alpha. They beat the market. So, so you find managers with good processes that can consistently outperform. Unfortunately, performance is terribly inconsistent. It's really hard to find managers that can do that. So if you're passive, you essentially just buy the market. We're talking about this in my wealth management class, right? AAA, I think you were there last time. I talked about core and satellite. Were you there for that? I'm a big believer in core and satellite. For me, I have a core portfolio that's like 80-90% of our portfolio, and I'm just going to buy the market. And I'm going to have 10% or so where I'm going to just go crazy. I'm going to put it in one stock I really believe in. Like right now, I'm a big believer in microbes. So I want some firms that are going to take advantage of that. I'm going to go find those. Battery development, some firm that's developing batteries that's going to do something crazy. Yeah, I'm going to try to find the next Microsoft. That's my satellite. So 80-90% just buy the market, just let it rise. I might be active on which markets I'm in, but I'm just going to buy those markets. So you have to decide how you're going to set it up. So you can be passive on 80% and really, really extremely active on 20%. However you want to bring that. But if you buy the market, you just buy mutual funds that are index mutual funds. You buy commingled funds that are index. You buy ETFs that are index. It's really easy to do. And they're all out there. They're out there for the S&P 500. Well, even we can even see. So let me find my list of. So the S&P 500, that's US large cap. We already studied that. What's the word we use for that? We don't say growth. We don't say value. We say, yeah, remember that word? I told you it a couple weeks ago. Value, growth, or core. Remember core? So if you do, so this is balanced. The S&P 500 is slightly skewed toward growth, but it's essentially core. It's essentially balanced. It's market cap weighted, so bigger stocks have more weight. So what's the biggest, if you buy the S&P 500, what's your largest stock holding? It can be Apple. Why? Because Apple's the biggest stock in the US market. The Dow Jones is price weighted. We don't even know what that means anymore. It's so bizarre. That means if a stock has a stock price of 500 and another stock has a stock price of 100, you can put 5 times more in the $500 stock than the 100. That doesn't make any sense. That's bizarre. We don't know why. And Dow Jones really isn't price weighted anymore because over the decades, they've had to adjust for stock buybacks and stock splits and some bizarre stuff. So it's a bizarre index. Small cap, for some reason, Frank Russell cornered that market. Sorry, I'm checking the time and thinks I'm checking that. So have y'all heard of Frank Russell? Y'all can Google him. I think his firm's up in Seattle. So he has the Frank Russell. He developed the Frank Russell 2000 stock index, which just became the standard for small cap. S&P has a small cap index. It's the S&P 600, but for some reason Russell 2000 won that market. Now there's the Russell 1000, which is the large cap, but Russell couldn't win that market. But we have both of them. What do we use in Investment Society? Anybody know that's been in that group? I don't think we have any in here. We use the Russell 3000. What is the Russell 3000? It's the Russell 1000 large cap and the Russell 2000 small cap. So it's essentially the US market. There's the Wilshire 5000 or 5500 or whatever, but it's all the stocks in the United States. There's the S&P 400. So S&P won on the mid cap, lost on the small cap, and won on large cap. Russell doesn't really have a mid cap. They probably do, but you don't know it. So they have a 1000 and a 2000, but they don't have a mid cap officially. So S&P 400, that's the mid cap. So the S&P has the S&P 500, which is large cap, S&P 600, which is small cap, and S&P 400, which is mid cap. You put all those together, you get the entire US market. All of these have ETFs. The Russell 1000, 2000, 3000, the S&P 500, S&P 600, 400, they all have exchange traded funds. Very easy to get. What else could we do on small cap, do you think? US small cap. What about US small cap growth? Could you do that? Absolutely, it'd be a piece of cake. What about US small cap? What else could you do? Value. Could you do that? Yeah, I love US small cap value. It's a great asset class. But if you don't want value and growth, what would you buy? US small cap core. That's what the Russell 2000 is. All right. Could you do US mid cap growth? Absolutely. US mid caps value? Absolutely. Those are all available. Developed markets, MSCI has won that. That's Morgan Stanley Capital Indices, but it's no longer part of Morgan Stanley. They spun it off. So it's just the capital indices. That's how they make their money, selling indices. If you could figure out how to do this, like Frank Russell, you can make a fortune. It seems like a really easy way to make money. You just sell your indices. So if you set up a mutual fund called the S&P 500 Index Fund, you have to pay S&P money to use their name. We had to do that at UTSA. You had to pay S&P money. Or you create your own indices. That's what Vanguard did. Vanguard created their own indices so they didn't have to pay MSCI. So MSCI, for some reason, has won the race on international. Does MSCI have US indices? They do, but we don't know. I couldn't even tell you what they are. I'm sure they have a US large cap indice, but I don't know what it is. I never have used it. But MSCI EFA, I can't remember what EFA stands for. So Europe, Far East. So I was going to say Asia, but Far East is Asia. So Maybe that's Australia. They have to stick Australia in there, but most people put Australia in Asia. But I don't know. So I'm not real sure what EFA stands for. And then you have the emerging market index. Does MSCI have a frontier market index? Absolutely. You could do that. It'd be pretty crazy, wouldn't it? But that can make you a fortune if we figure out inflation this next year. So MSCI has all of that. On the bond side, it's the Barclays aggregate. Anybody know what the Barclays aggregate used to be? A firm in 2008 that they bought. Lehman Brothers. So this used to be the Lehman aggregate. In fact, if you work for a bond shop, you'll probably hear them say Lehman aggregate by accident. It's like, oh yeah, Barclays, because we're such in a habit. Lehman was the bond king. They had all the best bond traders, this massive firm. And when they went under, Barclays bought them cheap. Why did they buy them? They didn't buy them for the firm, they bought them for the employees. So let's buy this firm before Lehman loses all these. Yeah, USA, I know at USA, our bond traders, if you listed all of their brokers, Lehman was not only number one, but was number two, was way behind. There is another bond aggregate index, it's Merrill Lynch. Merrill Lynch doesn't exist either. They got bought out by Bank of America. So don't start a bond fund with your name on it because you're going to go out of business. So you should know these. You should know the international ones, you know, UK, Europe, you should know those. But these are the main ones you should know for interview purposes. So don't go on an interview and say, you saw what the Dow Jones did, because we don't look at the Dow Jones in investments. That's what the retail market does. It's the S&P 500. You don't talk about the Dow Jones. I mean, Dow Jones, everybody's like, Dow Jones hit 30,000. I'd never even noticed that because I know the S&P, you know, trying to hit 4,000 or try to get up to 4,000. So I don't even recognize the Dow. The original indices, when they started thinking about indices back some years ago, sorry, there it goes again. 3:40, right? 5 minutes. So when they first started it, they said the obvious thing is just put the same amount of money in every stock. So let's get 500 stocks and let's put 1/500th in each stock. The problem with that is in 5 minutes, you're out of balance because everything's going to move in price. So something you started off with 1/500th now is a little bit more than that. Someone's a little less. So it costs you a fortune to rebalance. And how often do you rebalance? Once a month, once a quarter. And so someone said, you know what? Let's just market weight them because that's easy. Because you market weight, as the market moves, you're always in balance. Because as Apple goes up, your allocation Apple goes up, everything's fine. You'll see how that works. Market weight, just magical. Is market weight the best way to go? No. Equal weight actually does better than market weight. Why is that? Well, it's what we call value investing. When you do equal weight, you're underweighting the stocks that have really done well, and you're overweighting the stocks that haven't done well. So essentially, you're buying low and selling high. So it just over time, equal weight does better. But Fidelity, Vanguard, they don't want to do equal weight because it would cost them a fortune to do that. But you as a small investor could do that. And there are equal weight mutual funds out there if you want to buy them. So over the long term, they do better. They don't always do better, but in any given market, over the long term, they do better because they tend to be value investing. They tend to be buying cheap stocks and avoiding expensive stocks. And that brings up a whole new way to invest, which is fundamental weighted index. Robert Arnott, one of my favorite people in finance. Just great guy. I've only met him twice. First time I met him, he was speaking at a conference, and I thought he seemed kind of offish to me, like this guy, man, he's not very friendly. And then when I met him in person, he's actually a really nice guy. He's just a little shy, but he is a great conference speaker. He's kind of dry. He just says it, and as soon as he stops speaking, everybody runs out and changes their portfolio. Incredibly impressive speaker, very highly respected. I encourage you to go on YouTube and listen to anything he's on YouTube. Very impressive guy. He and Cliff Asness are two of my favorite. So any chance you get to listen to Robert Arnott. He was the editor of the Financial Analyst Journal, and when he was editor, it was the best the magazine ever was. It's really good articles. Great guy, very smart guy, but he has championed these fundamental weighted indices. He says instead of doing market weight, Let's find something else to weight. Maybe it's net income. Maybe it's assets. Maybe it's revenues. Let's find some other way to weight these stocks. Because market weights can end up giving you, you're going to put most of your money in the most expensive stocks, which probably are more likely to come down. And you're going to underweight the least expensive stocks, which are more likely to come up. Fundamental weighting is essentially very similar, where it's a value type of investment. You're going to tend to buy cheaper stocks and avoid the more expensive stocks. In fact, what I really recommend that you do is put Robert Arnott and Cliff Asness. His name is Asness. Go find debates between these two guys. Because Robert Arnott says, this is the way to invest. Cliff Asness says, all you're doing is value investing. They have this debate. They highly respect each other. So this isn't some kind of, drag out, beat up, bloody battle. They were two brilliant people, highly respected, debating each other in kind of a fun way. So you should definitely read those. I gave you the methodologies for S&P and MSCI. You can read them. We might look at them next class and see. I think I showed you S&Ps already. So, all right. Any questions on anything? So I'm going to find the companies for paper 2 here pretty quickly. If you have one in mind, email me. I found a couple that are not well-known companies that had massive stock movements that I think make it interesting to write about them. So I'll get those hopefully this weekend. All right, that's it. So you see that April 5th, 2010, we hit 4%. But what do you notice? Started going down. We hit 4% and then this, so we shot up to 4% pretty quickly. Then it was a long time. Oh, because there you have the financial crisis, obviously. Okay, then suddenly we got a bunch. So there's 401, 408. Now we're getting up there. Still, there we go. 2008, the summer of 2008 was the last time we've been this high on interest rates. Fortunately, in a future class, I'm going to say, you remember when, and they wouldn't have even been born yet. So hopefully you were born in 2008. So, but do you remember 2008? Let's see, how old are you? You're 7 years old, maybe. So yeah, I was still working at UTSA managing their stock portfolio. So it's been a long time since we've been there. We've been above 4 for quite some time. Is this a permanent thing? So last night I did the Lacey Hunt for the Investment Society. He really thinks recession next year, which means we'll probably see rates fall next year. So, he's lengthening, I'm lengthening on duration as well. Here's the yield curve. So the yield curve has, if you look at it historically, when it's above the line, so I'm taking, this is the 1 year minus the 10-year minus the 1 year. So when you're above the line, you have a steep yield curve. When you're below, you have an inverted, which means recession. Doesn't mean recession right there. It means a recession about 6 months out, and it's really, really good. So you can see here's the 2 recessions during Reagan's administration, where Volcker came in and just destroyed everything to get inflation down. There's George Senior Bush's. There's the 2001. There's the 2008 crisis. There's COVID just for a few seconds. Pretty amazing, this one, because this happened well before COVID, and it still said we're going to get a recession. This is a fairly negative yield curve. You notice these prior recessions, recession, 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 recession. What do you think? Now, some people say, yeah, but you can't look at this one because the Fed's balance sheet's ridiculous. We've got all this stuff going, they're arguing against it. But recession, 2 recessions, it's been amazingly effective. How negative is it? Well, we're at negative 49 basis points right now. The 10% is only 28. 5% is much more. So we're kind of at a 95% point on the yield curve steepness. But those extreme cases were the early 80s when we had, Volcker just really, why was the yield curve so negative there? Well, everybody knew Volcker was going to put us into recession, bring things down. So it was just so obvious. So people say, you know what, short-term rates might be 18%, but I'll lock in a 10-year treasury at 15 because rates are going to fall. That 15 is going to look really, really great a year from now. And that 18% short-term rate is going to probably be 11 or 12. So have this chart in your mind when you interview. Y'all are interviewing this October, right? This is the time you're all interviewing. This is what the people you're interviewing with are looking at. The yield curve is screaming recession. Quite a strong recession. That's, you know, it's the last four we've had were that low or lower in those last four. So definitely something to keep in mind. What kind of jobs are y'all interviewing for? Who's seeking UTSA students? What do y'all have lined up? Nobody has anything, or you're too shy? I've gotten Valero begging me for students. I've had several other firms begging me, you got to send me some students. But I haven't graded your first exam, so I can't send them your names yet. Although some of you are in my prior classes, so I could certainly send them your names. So yeah, I have firms begging for UTSA, especially society members. They just want UTSA students that are active outside of class. So firms are definitely hiring, but you got to go post. How many firms do you apply to? If I were you, I'd be doing 5 to 10 a day at a minimum, or 50 a week if you can't, do it all. How long does it take to apply for interview? I don't know. It probably takes about 5 to 10 minutes a company. So 5 a day, you're talking about an hour a day just to apply. I would take advantage. COVID's been a huge advantage where a lot of interviews are still Zoom and online. So they don't have to come to UTSA campus. You can apply. I remember one firm, I can't remember the name of it. It starts with an E. It's a firm that had never hired college students before. They only hired people with experience. And so they started an entry-level college hiring. They'd never done it before. One of my students interviewed with them. He got the job. He had some special circumstances, but we worked it all out. We talked about how to get that on his resume. They hired him. I went and visited him a couple years later, and they were all fighting over him. His boss quit and started a new firm. His boss wanted to take him with him. The person took his boss's place. They were fighting. These two people were fighting over UTSA students. And so I said, that's good. Their first experience with college hires and with UTSA, and you've set the bar really, really high. And he's doing great. He's really, really doing extremely well. Okay, it was Equifax. Yeah, he interviewed with Equifax. All right, so I've got some companies out there for the earnings report. So FedEx is a little bit old, but they had a huge earnings surprise and it really hit the news. So you can probably find some pretty good articles on that. Netflix, obviously, that's a big one, just came out. They beat by a lot and their stock price shot up. United Air, about the same time, they beat on earnings. And they're positive versus being negative a year ago. Constellation Brands, they beat. I think they're interesting because while they beat, their stock price was down. I always find those interesting. I think that's what you're going to see on Tesla, right? Everybody's going to want to do Tesla. Tesla beat and their stock price is down a bunch. I find that those are the interesting ones to talk about. And you say, well, they missed on revenue. Yeah, but they just barely missed. So that one's there. You probably never heard of this firm, Lamb Weston, but they beat by 49%. And their stock was up 4%. So that could be an interesting one. AZZ, you probably never heard of them, but they missed by 26%. And their stock was down 22%. So there's an interesting one. And then Tesla missed revenues by 2.7%, but their revenues are up 56%. So the stock market is killing Tesla because they thought their revenues were going to grow 58%. And they only grew 55%. That seems a little excessive, doesn't it? But that's what they're saying. And so their stock is down about 7%, but their stock was down a bunch more early in the day. So there's Tesla, and then Abbott Labs beat by a bunch and their stock price fell. So another one where they beat their stock price is down. I find that a lot more interesting. Now, there's a few ways we can do this. You can pick one of these companies or tell me another one you want to do. Or I was even thinking your team could all pick one company and we could set up a Zoom where we all work on your papers where they're due. You have to kind of decide how you want to do that. So think about it. But I don't want everybody doing Tesla or Netflix. There are other interesting ones in here. So from an interview standpoint, what should you pick? You should pick Lamb or AZZ. In an interview, it's really impressive. You talk about a firm no one knows about. When you go on interviews, yeah, I was looking at this firm, AZZ Incorporated, and they, what, who is that? What do they do? Oh, it's a firm that does this. And they've never heard of them. You talk about the earnings. That's really impressive. You go in and talk about Tesla. Everybody talks about Tesla. So yeah, big deal. You're not impressing. So Lamb and Tesla are two interesting ones, but Lamb and AZZ, and I can't even remember what they do. Abbott Labs is another interesting one because that's one the people are interviewing with know because it's a really big firm, but we don't, unless you go get blood tests a lot, you probably don't know them that well. So an interesting firm. So there's some good ones in there. So think about what you want to do now. Is there a firm you want to do that I didn't mention? There's some really big, this is earnings week. So today, I prefer NASDAQ's calendar, but they don't have all the stocks. Yahoo Finance has more stocks, but what I love about NASDAQ is they put the market cap. So I can look at the big, so Danaher, who's a big competitor for Danaher? Well, Abbott Labs. So that's why I compared those two. Philip Morris, cigarette company, comes out. Union Pacific, a transportation company. AT&T, the most boring company in the world. I used to own their stock and just watched it at $30 for like 4 years. And I finally said, you know, I can go buy another stock. They wouldn't go up, they wouldn't go down. Nucor, good old Texas. I did not give you any banks. Why didn't I give you banks? Because we're going to look at gross margin. And banks don't have gross margins. They have net interest margins, and I didn't want to pull that in. You're going to notice on United, for some reason, Bloomberg does not bring in gross margins for airlines. So if someone wants to do United, I can get you a margin that we can look at, but I can't give you what the expectations were. So United has that risk. So if you go to Yahoo Finance, they do have a gross margin. So I don't know why Bloomberg doesn't bring in a gross margin for United. So what I will do sometimes, because it's more interesting to me, is rather than doing a gross margin, I like to take the revenues minus fuel costs and look at that. I find that is a really interesting number. So that we could probably bring in, but United doesn't have a gross margin, so you just can't talk about their gross margin. But you might find articles that actually mention their gross margin because they do report one. It's just that Bloomberg, for some reason, doesn't show gross margins. They don't show gross margins for insurance companies or banks or airlines for some reason. So I left the banks out. The banks have been really interesting. Wells Fargo especially was really, really interesting and would have been a good one to do, but I didn't want to have to pull in the net interest margin. Wow, some big companies. I drive by these people all the time. I can't see anything in that store I would ever buy, but I'm sure they have a good clientele because I just don't buy stuff like that. Dover, another good kind of in huge, pretty good size firm, 17 billion. Quest, another Abbott Lab type competitor. Snap-on, interesting company. There's a lot of really good companies in here. So it's possible today there may be a company that we should bring in. Yesterday we had some really good companies, Tesla, Procter & Gamble. I looked at them. One thing I would do, they may have had a really interesting report, but their stock didn't move. And it makes it really hard to talk about the stock if its stock's only up 0.1%. So I just kicked them out if they didn't move much. Friday, you have Verizon, another boring Schlumberger. Yeah, I don't know if any of those will be too interesting or not. So we'll see. So let's stop this week though, unless you just see something so crazy on Monday because they're starting to run out of time to do the actual paper. Yeah, I don't see anything there that's going to be too exciting. All right. So you have the data. So what data do you have? So you have they're reported. So comp is the important one. Make sure you have that in your notes. So there's reported earnings and there's comp. The comparable earnings, that's what the market looks at. You do want to look and see if there's a big difference. You can see with FedEx, they're essentially the same. The comp is the market is saying we were expecting $5.03. They actually made 3.4 cents when you adjust for any unusual items, but they actually reported 3.445. Okay. Sometimes the comp can be a lot different than the reported, but generally not. You can see with Netflix, it was the same, 310 and 310. So you can essentially ignore this reported column. The only time to worry about it if the reported and the comp are radically different. I don't know if I can find one that's like that. There's one. So Constellation Brands, they reported $4.65, but the market is looking at $3.17. Why? Because there was some adjustment, quite significant adjustment. So if you did Constellation, you need to mention what that adjustment is. The way they usually say it is Constellation Brands reported $4.65 in earnings per share, comma, $3.17 after adjusting for and what that is. And then the rest of your paper is all on the 317. You never mention the 465 again. Okay, so you just want to say what that is. So that's a pretty big, and you notice Constellation Brands, they have that adjustment every single time, including here. Look at that, pretty radical adjustment. But everything, you'll notice this estimated surprise is not off the reported earnings, but off the comp. And the articles are going to do the exact same thing. When they say they beat by 13%, it's off to the comparable. They beat by more if you have reported earnings, but that's not what we're looking at. Now, it is possible this comp will be different in an article versus what I'm showing here, because, you know, different people have different opinions on how you adjust for that. All right. So what else do you look at? Well, this section right in here, you can essentially ignore that, other than if you want to just look at the trend. If you want to get a longer term trend, go to Bloomberg, you can get this report. It's pretty easy to do. I actually have a YouTube video that shows you how to do that. So you can go back and look. That can be interesting. You want to say this was their highest earnings in history, or this was their lowest earnings in 5 years, or whatever you want to say. So the historical can be there, but you can essentially ignore this middle section. We compared to the quarter a year ago because of seasonality. So FedEx, the market expected $5.03. They only made $3.44, so they missed by 32%. And they were below last year by 21%. You notice I'm not talking the annual numbers, I'm only talking quarterly. When did the annual numbers come up? Well, if this was their fiscal year end, you might see some discussion on annual numbers. You can, for this paper, entirely ignore the annual numbers. You'll see it. You can bring it up if you want, but you can entirely ignore it. You can just focus on the quarter. That's really what your boss. So you think about your boss. Your boss comes in. She's got to be in a meeting at 10 o'clock. She calls you at 8 o'clock. She's driving in. You're supposed to be there when your boss shows up. So you're sitting at your desk. She's calling you. Don't always assume she's calling you from the car. My boss would used to call me. He'd be walking right up the aisle while he's talking to me. And I'm like, oh, I can't believe he's bothering me. He's walking right behind me. So don't assume they're always in the car. But she's calling you. She said, hey, we own FedEx in the portfolio. I heard some rumors. The earnings report wasn't very good. I'll be there at 8:30. Have a report on my desk. That's a pretty common request. You have 30 minutes. I'm giving you like 30 days. So, you know, I'm a much easier boss than your boss. Why do you only have 30 minutes? Because in 30 days, who cares? That's old news. So I'm giving you a lot more time than your boss is going to give you. So we look at that. We also look at revenue. They barely missed on revenue. And the revenue is higher than last year. How can their revenue be higher than last year and their income lower? Well, we have inflation. Obviously, it costs them a lot more to drive around, fuel costs, airplanes, those kind of things. So obviously, even though the revenue is higher, their earnings are going to be much lower because of higher costs. Their gross margins, notice here, I do it in basis points. Why? Because gross margin's a percent. So you don't say they missed by 12%, they missed by 500 basis points. So that a pretty significant miss there. And they're lower than last year. You expect them to be lower than last year just because fuel costs are up so much. So I'm somewhat surprised the market was expecting a really good gross margin because of fuel costs. And then their EBITDA margin. So this is their EBITDA. I mean, their EBITDA. So you don't really need to talk EBITDA, but you need the EBITDA to get the EBITDA margin. So EBITDA margin, that's your EBITDA. Anytime you see the word margin, you're dividing by revenue. So their EBITDA margin is EBITDA divided by revenue. So they missed and they were lower than last year. So you see how I have the spreadsheet set up for each company. And down at the bottom, I give you a couple of things. I give you the chart. So here you can see the earnings report came after close of business on this day, on the 15th. And it either came after close on the 15th or before open on the 16th. You can just tell when the market reacted. I didn't do the overnight here. If you want the overnight, you can do that from Bloomberg. You notice there's a little button right here. If you click on that, you'll get the after hour trade, which can be interesting because if they report, say, at 5 o'clock on the 15th, you can see the immediate reaction. Sometimes the immediate reaction is really wild. Like you saw with Tesla, I think Tesla was down 12-something%, that immediate reaction when the news first came out, but then it recovered somewhat. So you can do the overnight. I didn't do that. Go to Bloomberg, you can certainly do that. And then the stock itself was down 21%. The S&P was down 0.72%. Their industrials were down 2%. Now I put UPS in there. UPS was down 4.5%. Those are the kind of things you'd want to talk about. Why is the market being down so important? Well, because it was a down day for the market. Obviously, 21% is a pretty big deal. If the market had been down 25%, radically changes your discussion about FedEx. But obviously, FedEx had a really bad day that day, and it hit the news quite a bit. Netflix was up when the market was down. I put Disney in there. I wasn't really sure who else to put in there. I think Disney still owns Hulu. I don't know who else. I think HBO is private, aren't they, or Paramount? So no, it's hard to find a competitor to Netflix. You could say Apple and Amazon, but they do so many other things. But I just put one other company in there. But Netflix up 13%. Was Disney up because Netflix was up? Thinking, hey, well, they reported good numbers. Disney will probably report good numbers too, or who knows? I don't know when Disney reports versus Netflix, so it's hard to say. United Airlines had a good day. So did American when the S&P was down. Constellation Brands was down. Why is that so interesting? Because they had a really good earnings report. So that's why that one's interesting. Lamb was up 4% when the market was down. And Lamb produces like snacks or something. So I put General Mills in there. I'm not sure that's a real competitor, but in this firm, I just don't know, but they were down 22%. So I thought it was kind of interesting. So you might find something there. Tesla down 7%, but down a lot more earlier, and Abbott Labs down 6% with a pretty decent report. Abbott Labs will be the most interesting one there. They beat on earnings, they beat on revenues, everything was good, and their stock is down 6%. That seems like a really, if you're a finance major, like I got to go check. I don't even care if I write my paper on this. I got to go figure out why is a firm down with those good numbers. Now, what else could you do? Well, you got to find some articles. Articles are pretty easy. You just do Netflix earnings report. All kinds of articles will come up. Netflix adds 2.4 million more. Netflix third quarter earnings report. Did Netflix beat Netflix earnings report? Seeking Alpha is not a bad place to go. There's going to be plenty of reports to go. Now, the AZZ company, you probably won't find as many reports, but they will. Now, investor relations, that's a biased report because that's the company. So you got to be a little careful there. They're obviously going to say, hey, everything was wonderful and great. But you see, I'm still getting even Seeking Alpha. Seeking Alpha, sometimes it's great, sometimes it's horrible. So it kind of just depends. They'll give you a lot of data, but sometimes they actually have a discussion there. They're just giving you data. But still, even with AZZ, you're seeing quite a few 30 comments. What you're trying to do is figure out why did they report what they did and why did the market react? So Abbott's a really interesting one. Why did Abbott do so well? And then more important, why did the stock market not like it? The other thing you can do is do the conference call and actually even just listen to the conference call. A lot of times, well, here they show Motley Fool has the transcript. The transcripts, if it's written by a computer, they can be really, really bad. So I almost want to listen. A lot of times they'll have the actual recording. Bloomberg often will have the actual recording that you can listen to the recording. If you've never done that, do it for this paper, just so you can say you have when you get to interviews, because it's a good thing to do. What do people in finance talk about? This is the sell side. These are the people who know these companies as well as management. What does management tell them? Because obviously management's talking to people who know their company really, really well. So there's going to be a lot of jargon. They're not going to explain basic, obvious things because they're talking to very knowledgeable people. It's going to have a positive bent to it because it's management. And then the sell side comes in. What questions do they ask? What are they worried about? What did the sell side ask Netflix? So those are the kind of things you want to, if I were talking to Netflix, I want to know what their production budget is. What are they working on? Where are they putting their CapEx? That to me is really important because subscribers, what's drawing people to Netflix right now? Is there any major show that's really drawing people there? I haven't been on Netflix for quite some time, so I don't know. Or Hulu, what's Hulu got that Netflix doesn't have? What does Disney have? Where are people going? Why did they get more subscribers? So that's really what your paper is all about. I'll show you some example papers as we get closer to the actual due date, and then we'll talk more about it. But any questions on that? Has anyone already picked their company? Anybody know yet? So this is out there. There is one or two numbers that are in green. I couldn't get the adjusted EBITDA for Netflix. Hopefully it will show up. If it doesn't, I just put the reported. You notice they're usually different. So I can't be for sure that's right. And I think one other firm, I couldn't get that number for, but I don't remember which one it was. One of the firms. Yeah, I guess Abbott Labs. I couldn't get the reported number, but that's probably okay. You don't really need that number. So there's two numbers I couldn't get. I gave you the graphs, but you can obviously create much better graphs. It's okay to have these ugly Bloomberg graphs in your paper because it is impressive to have a Bloomberg chart in a paper. So you don't need to avoid that, but you can find other graphs. If you don't have a Bloomberg account, you haven't sat down a Bloomberg machine, this is the perfect paper to use Bloomberg. There's a lot of stuff on Bloomberg. One thing you can do on Bloomberg is go to the news function, find the date, type in the company. So they'll let you do a detailed search. And on Bloomberg, you'll find all kinds of articles that you can email to yourself. It's a really good source. Not only that, go to AV and do the same thing, audio visual. Then you'll find actual videos of people talking about Netflix. And those are always really, really cool. And there's a lot of them. Bloomberg, I've been on Bloomberg TV. Oh gosh, I think I did it twice and I said never again. It was so stressful. Oh my word, it was so stressful because it was right in the middle of the 2008 crisis. Freddie Mac had just announced some major disaster. I don't know anything about Freddie Mac and Fannie Mae. The first question they asked me, so all weekend, I'm like, tell me everything. And then I get on the TV. I can't tell while I'm on the TV. I'm like, am I on now? I'm on now. And I can't tell. And the USAA people are saying, make sure you talk about this, and this. I'm like, leave me alone. I can't tell. It was really stressful. I was like, I don't have a face for TV. I don't have a voice for radio. I love the newspaper people. They were a lot easier, but there's a lot better people than me out there doing these interviews. They know these companies really, really well. So you can listen to those interviews. Why would you do that? It helps the paper. But then when you get in an interview for a job, you can say, yeah, I was watching Bloomberg video on Netflix earnings report and so said this. That's what finance professionals say. College students don't say that, but finance professionals say that. So you see how this paper is going to give you some good ammunition for your interviews. Okay, questions on paper 2. I'm kind of jealous of you. This is my favorite paper. Really, it's a very fun paper to write. You can really get into it, do quite a bit. Okay, and I've already done most of the work with you for you. I already pulled all the numbers. Okay, let's talk more on execution here. So active versus passive. You're going to try to beat the market. Last class, we talked about what is the market: small cap, large cap, growth, value, US, non-US. So if you're passive, you're going to buy the market. You're going to buy index mutual funds. I bought one just today. It charged 2 basis points, almost nothing. It's almost free. Commingled accounts, ETFs, exchange traded funds. The one I bought today was an exchange traded fund, very, very inexpensive. So if you do that, you usually think markets are efficient. Now, I don't know if you've had the efficient market hypothesis yet in the class. It's a very famous theory in finance developed in the 70s by Eugene Fama. And when we mean markets are really, really efficient, what we mean is they do a really good job of 2 things. One, assessing information. When information comes out, they assess it and they react very, very quickly to it. And they're also really good at putting that information into the price of a stock. So information efficiency is, boy, they react to information really fast and correctly. Fundamental efficiency is they put it into the price of the stock very efficiently. So the stock market, information's, it's hard to have an information advantage because the market reacts so quickly, and stocks are almost always correctly priced because we're so smart in this information, the price goes. So which of those is true? This first one's definitely true. When I was a security analyst, I probably told you all this story, so I can't remember. I'm 60 years old, so I'm going to tell you the same stories 4 times. But so I'm a security analyst. I'm about to go home, and no one's leaving. Did y'all tell y'all this story? Everybody's just sitting there. You feel really bad, right? When you start a new job and everybody's just sitting there, and you're like, it's 5:30, and they look at me like an idiot. What do you mean you're going home? IBM's reporting after close. I go, IBM. IBM used to be an important company. They used to be the biggest tech stock, and when they reported, everybody, now it's not such a big deal. But then IBM was. In fact, IBM was the biggest tech company and bigger than almost all the rest of them combined. So it was massive back then. And you say, yeah, this is really important. Even the non-tech investors want to know what IBM was going to do. So I said, okay, well, I'll sit around. I'm not investing in IBM. It's not in our portfolios, but I'm curious. Do you think I knew when IBM reported? Was it pretty obvious? Yeah, it was crazy. You would have thought there was an explosion in the building. People were running crazy, yelling, screaming. It was the second it came out. How fast did they get that? They were to their computers, putting into their models, updating their numbers. Yeah, it was very, very rapid. So I believe that. The fundamental efficiency, is it possible the market is really bad at pricing securities? The securities always correctly report the correct price, or if analysts make errors, their errors should offset each other. So those who go too positive are going to be offset by those who are too negative. There shouldn't be a one-way bias where 90% are too positive or too negative. So it doesn't mean they're all correct. It just means the average is really, really good. And that's the big debate. Is it possible for a stock to be obviously mispriced? So simply we're talking about with Tesla, right? When Tesla got bigger than GM and Ford and everybody else combined, even though they sold a fraction of the cars of those companies, and people were saying there's no way Tesla's correctly priced. So it's possible. Was NVIDIA mispriced a year ago? Is it just grossly overpriced and now we've repriced it? Or did we get new information that showed us that they were priced correctly back then, but now we have new information? You can debate that. We don't really know the answer to that. But this one's a little shakier, especially saying markets are never in bubbles. People do believe there's bubbles. And if you're interested in bubbles, market bubbles, not other bubbles, maybe other bubbles might be interesting too, but market bubbles, one person I really recommend you read, which is his name is Grantham, and he has written extensively. See, I didn't have to talk the word bubble. He's gone back and looked at all prior bubbles And he explained, he thinks we're in a bubble now. He thinks the S&P is going to crash dramatically. And he was saying that before the sell-off. So last year he was saying that. There he is right there, August. So even earlier, much earlier than that. So he's talking about a super bubble. So this isn't like a 2008 bubble. This is bigger. This is a super bubble. Now he's getting up there in age, so maybe he's lost his touch. But and I can't even get on the Barron's, but he's done a lot of research on this, and he's written several articles, and they're very, very interesting. This is a good perspective to have coming out of college because, you know, especially from an interview standpoint, it gives you a lot of stuff you can talk about that people would find really interesting. And that's like the best interview you can have is you start talking to something about something and the person interviewing and going, wow, that's interesting. You know, if you can actually tell them something that they've never heard before, that's pretty interesting. So Grantham does that. Here, if you want to watch the 30-minute interview, I would recommend do that. He is a major player in this industry. He's the G of GMO. So you can go to GMO's website and register. You can see all the articles they've written. They've got some really, really good articles, really good videos too, probably. But there he is right there. He's getting up there. Not the Jeremy Grantham. I think he's in his 80s. We'll see. 84. So he's one of these people that has started a firm, very famous, and now he comes in the office like once a week, walks around for 30 minutes, and he leaves and he even admits that I'm not investing anymore. His other big thing is global warming. He's a very big global warming person. So you'll see him on those two issues. But this is the one I think is probably the most fascinating that he's done some really interesting research on. So that's the idea of bubbles. Are we in a bubble now? He says we are. So you can certainly debate that. So what is market efficiency? So I don't spend too much time on this. You can read about it on Wikipedia, but just real quickly, Eugene Fama, back in the 70s, he wanted to test, are markets efficient or not? Essentially, he's asking the question, how easy is it to beat the market? Can an average person do it, or do you have to be really specialized? Or even the really specialized people, can they not beat the market? So he did 3 tests: weak form, semi-strong, strong form. Have y'all done this in any other class? This is your first time to see this. So you have to know this because it's a big deal, but you don't have to know it. Yeah, I think I've covered as much as you need to know. You don't have to know it in intense detail. So weak form test, can you look at past prices to predict future prices? This is what technicians do, chartists do. All right, there's some great books on this. Technical analysts are trying to say, hey, this stock was trading in a range and it broke out of a range. That means it's going to keep going higher. Those kind of things. What do tech analysts say? Well, it's really interesting. It seems a little inconsistent, but technical analysts, they believe markets are extremely efficient on a fundamental basis. They think markets are very good at processing information. The reason they think technical analysis works is you get these supply and demand imbalances. And they believe when markets are in balance and supply and demand, you can see it in the prices and you can make a trade. So they actually believe in market efficiency, but they believe markets get out of sync, not because they misinterpret information, because buyers and sellers get out of balance. And they say they can see that. Is that true or not? I don't know. A great book on that is Dr. Andrew Lowe has a good book on that. I recommend you read, if you're interested in technical analysis, I highly recommend you read Andrew Lowe's technical analysis book. The semi-strong form says, can you use public information, including prior prices, and beat markets? And his answer on that was no as well. He said, boy, having information that everybody else has, you can't beat the market. Now, it's hard to test that one, but he says there's no evidence. People have superior ability to interpret this information. The strong form test says if you had all information, including non-public, could you beat markets? Well, that one's really hard to test because you don't know who has non-public information. He tried to test that one by looking at trades that CFOs and CEOs made of their own company, because obviously they had inside information. But yeah, it's hard to test. But he said Doesn't work. Doesn't work. We don't know. Now, is he the final say on this? Dr. Lowe says does work on weak form. So his book is pretty interesting. I showed you James Simons. James Simons says it works, and he's made a lot of money on that. So if you believe markets are extremely efficient, you probably just want to be a passive investor, because it means you really don't have much hope of adding value or finding someone that can add value. You should just buy the market. Why should you just buy the market? Well, your chances of beating the market are really low. Plus, trying to beat the market is going to cost you a lot of money. So you're already starting off behind. So, I bought the index fund today for 2 basis points. They don't have to do much to earn their fees back. I find another fund that's charging 0.8%. I'm already starting off 7, 8 basis points ahead. So you might as well just go passive. Or you can use non-public information. What's the problem with doing that? So you're sitting on the plane and the CEO of Valero sitting next to you, and he or she says, man, when this hits the markets, boy, our stock's going to take off. What can you do with that information? They don't know you're eavesdropping. You just know it. You recognize the CFO. They don't mention that's Valero, but you recognize that it's the CFO of Valero. And they say, hey, when this information hits the market on Thursday, boy, our stock's going to shoot up. What can you do with that information? Absolutely nothing. What if you do something with that information? You go to jail. It's illegal. What would you actually do if you're working for Victory Capital and you hear that? The first phone call you make when you get back to your office is to whom? To the corporate lawyer. What do you tell her? I just got inside information on Valero. You don't tell her what the information was, because you don't want to make her go to jail when she calls all her aunts and uncles. I just got inside information. What's she going to do? She's going to call Valero and said, someone overheard you on the plane. You need to get that information out today, because you spilled the beans. Someone else might have heard that. That's the process that can go up. Now you say they're never going to catch me. What's the SEC going to do? The information goes out, the stock goes up 20%. You say, oh man, Jacob in San Antonio, he just bought 1,000 call options on Valero. He's never bought a call option in his life. Oh, look, he was sitting in a row ahead of the CFO of Valero. That's kind of interesting. So Jacob said, I'll get away with that. I'll call my uncle and he'll do it. And they say, oh yeah, Jacob's uncle, this guy has a nephew who was on a plane. They're going to figure that out. That's what they do. You might get away with it because you're a small investor, but even Martha Stewart made a small trade and went to jail. I don't think she went to jail for insider information. I think she went to jail for lying on her oath. But that was what she went to court for, was inside information for a really small trade. I mean, this is a very wealthy person and ended up going to jail for almost nothing. So you can't do that. If it is material, if it's immaterial, you can trade on it. But who decides if it's material? You don't decide that, do you? It's up to the court to decide that. What if you had 1 million pieces of immaterial information that together were material? That you can trade on. I don't know how you get 1 million pieces of immaterial, non-bulk information, but you can trade on that. But again, you'd have to go to court and you have to prove every single one of those was immaterial. Even though they could prove you and you put it together as material, that's okay, you're safe. So the best thing to do is you get information that only you know and no one told the public, is don't do any trading. Tell your lawyer it's out of your hands, and then just don't even think about it again. So this is a big deal. All right. So if you're going to be a passive investor, some people have said, well, but the stock market has a purpose. The stock market decides on winners and losers, and we need them to do that. That's called allocative efficiency. We need the stock market to tell us to put Circuit City out of business, put Toys R Us out of business. We need someone to do that for us, decide who's well managed, who's poorly managed, who's got a good business model. And if we're all passive investors, nobody cares, who's going to put the heat under management. So that's been an issue. BlackRock thought they had a solution, and I thought it was a pretty good solution. BlackRock has a lot of passive investors because they have the iShares, which is a massive passive investor. So what BlackRock said is, we have a lot of active investors, we have passive. So what we'll do is we'll take our active investors and they'll they'll tell the passive portfolios how to vote their shares. So we'll still have that scrutiny. So what's happened to BlackRock since then? Texas politicians hate him. Why? Because he's pushing, green technology and all that kind of stuff. California politicians hate him. Why? Because he's not pushing green technology hard enough. He can't win. Is he glad he decided to do that? Probably now he's probably not, because he's just getting beat up all over the place. But now we're seeing politicians say, we don't like you voting your shares based on global warming because you're going to hurt the state of Texas where we sell a lot of oil or whatever. So who knows? But this has been a major issue. But who knows? Right now, I think passive investing, the numbers I see, it's about 30% of the investors. So, but majority of investors are still actively investing and making decisions. I think the bigger issue on this is the institutional investors. They're the biggest investors. They don't try to change management. When Fidelity and T. Rowe Price, if they don't like a company, they don't go in and try to clean it up and fix it. They just sell the shares and they move on to somebody else. So what do you really want? What do we call them? The activist investor person that's like Soros or whoever's going to come in and say, we're going to fix this company, change management, we're going to clean house. We need that, don't we? In an investment world, we want people coming in and saying, hey, this is a great firm if you just had a better CEO. You as an investor want that. So you might even look for stocks and see what percentage of their ownership is activist investors, because that should serve you well. You want someone out there saying, hey, management, you're making bad decisions. Come on, do your job better. So, or you just invest passively and don't worry about it. I love Warren Buffett, what he says. He says, investing is like batting where they never call strikes. So essentially he's saying you can be patient. I've seen others say this as well, that beating the market's hard if you're short, if your horizon is really short. But if you got a 3 to 5 year horizon, you can beat the market. You just wait for things to get really cheap, get really expensive, you jump in or are short and you're good. Unfortunately for me, in my profession, is we were paid to swing. So my boss says, what have you done? What are you doing? What are you doing today? What trades are you doing today? And I couldn't say nothing. I had to be doing something. We're all this pressure. What are you doing? You got to do something. The Fed's doing all this stuff. So patience is not compensated in our market, which means you as a small investor can beat the market if you're patient enough. Most small investors aren't. Or what else could you do? So there is an alternative. And I do recommend, I don't think I've had, but a couple of students actually do this. Have you ever heard of family offices? Does that sound familiar? So a family office, these are these really rich people. They have billions of dollars. And they want to invest it. So they create this investment firm or investment portfolio. And they hire people just to manage that portfolio. Family offices tend to be the most patient investors there are. They say, oh, you know what, you're having a bad year. Yeah, we expect that in this environment. And they're looking at 3-5 years. I've heard some podcasts of people who work at family offices, and it sounds to me like the world's best job. So like the most fun place to work. I hate, what I hate about my job was this thing of they graded me. It was just ridiculous. I was ranked on Lipper, that I rank in the top 20%, top 30%, top 40%. They looked at that every single day. It's like, Ron, you went from 31st to 29th. It's like, oh, great, that's wonderful. Well, on Wednesday, now you're back to 34. It's like, give me a break. This is just insanity. In a family office, they don't care. It's their money. They can be patient. They can do all kinds of things. They can say, hey, we're going to do this strategy. We might be 9 months early, but this thing's really going to work. And they're like, yeah, fine, that sounds great. So what are the good family offices to work for? I don't know. But you might want to interview with them and just see. There's one pretty famous one, but I can never remember it. They do the buffet, the big buffets. You know, what are some of the name of those? I can't remember the name of them, but there's one family. They did this home buffet or whatever thing, and I made billions of dollars back in the 70s, and now this is what they do. Family office sounds pretty cool. So there all are alternatives to being short-term investors. All right. So a few other things we'll hit real quickly. As an investor, you can buy securities You can sell securities that you own, and you can sell securities you don't own. It's a really unique part of finance. Pretty cool. You can short securities. Have any of y'all tried shorting securities in here? I don't do it very often. Done it a few times, but if you short securities, you got to be watching that thing every second of the day, because you can lose a lot of money shorting securities because there's unlimited loss. If you buy a security, the most you can lose is what you invested. When you short a security, you can, the limits are infinity. I don't like infinite losses. So I'll talk about my strategy when you do that. But you sell something you do not own. So you might sell it for $100 and you hope its price falls to 80 and you buy it back at 80. So you made $20 and you didn't invest anything. So it's an infinite return. You invested 0 and actually you got paid $100 and you only had to pay back 80. So you made $20 with 0 invested. It's a pretty good. So here's my advice though. Never short without a hedge. So let's say you were going to short NVIDIA stock at $300, $350 or whatever it was back then. So you sell it for $350. That would have been a really good decision because it's fallen so much, but it could have gone to 400, it couldn't have gone to 500. I would have shorted it at 350 and then bought a call option like at 420 buy. So the most I could lose would be at $75. So I don't like infinite losses. It just makes me really, really nervous. So I would say short, because buying that out of the money call option, it's gonna be pretty cheap. And if you're right that NVIDIA is falling, you can just write the call option off. It was your insurance. Maybe you lost a couple of bucks and then you make $100 when it falls. So yeah, so be careful. These are infinite loss. I remember I was what we call Y courting at USAA, or I was listening in to our sales reps. And I heard a sales rep said, "Do you realize you have this stock short?" And the customer goes, "Oh yeah, did I, is that still out there?" I was like, they had almost taken me off the floor. It's like, you have a short security and you forgot you shorted the security. That doesn't make any sense to me at all. How do you get that security? Well, whoever your broker is, they can't short that security unless they have it somewhere. So they have to go and look in their inventory. If one of their investors have that security, they can sell that security. But what if that investor wants to sell that security? Well, they got to give it back to them. You may not notice it because they go borrow it from somebody else. But what if they run out? I remember we shorted, I was working with this guy, we shorted tips. We thought that was pretty cool to short tips. And then the broker called and said, "You're going to have to buy it back." I was like, "No, just short it again." And they said, "No, we shorted the security and that person wants to sell it. We don't have any more. It's not an inventory." So you can't short a security. It's not an inventory. Which means you better, if you're going to short securities, you better go with a broker that's massive. It's a big portfolio that you can have a lot of securities that you can short. How does it work? It's kind of interesting. You borrow their stock and you got to put up collateral. The collateral can be your portfolio that's sitting there. And so if you short it at 350, you have to put 350 times 102 as collateral there. It can be just, you don't have to actually send them cash. You can be whatever your existing portfolio is. They're going to pay you interest on what collateral you put aside. And then, when you go back, it's, you get all your money back and you close out that account. So there's going to be a little bit of interest kind of earnings going on. It's an interesting field. There's an industry all back behind this called securities lending, and that's what they do. They set this whole thing up. So we did securities lending at USAA. We would actually tell brokers, lend our securities. We'd actually have a contract with them, lend our securities first, because we could make money on that. So we get collateral, we have to pay interest on the collateral, but we may only have to pay 1% interest on the collateral, and we go invest at 3% and we made the spread. So we actually made money on securities lending. Vanguard does it, USA does it, everybody does it. I was looking at Vanguard. Vanguard might charge 8 basis points for a fund. They're probably making 10 basis points on securities lending. So they actually make money lending out their security. They make it through the spread, what they pay on the collateral versus what they make on the collateral. So it's an interesting field. I don't know who the biggest securities lending firms are out there. The firm we use actually hired Al Gore on their board. I don't think Al Gore knows that much about securities lending. He might. I think they just wanted a big name on their board, kind of like BlackRock hired Fisher, just to get a big name on your board. He might. Al Gore probably knows a lot more than I would imagine, but so it's an interesting field. Now, when I was at USA in 2008, we got complaints about securities lending because in 2008, people thought the people shorting stocks were driving the market down. And so we're getting calls and says, you shouldn't allow anyone to short your securities. You shouldn't do any securities lending. I answered to them as we're going to keep doing securities lending because we're making money doing it. If we stop doing it, we're harming our portfolios. So we're going to keep doing it. They couldn't get us to stop. There was a time in 2008 where they said no more shorting bank stocks. That seemed kind of crazy to me. If bank stocks are overvalued, we want people shorting them so they get to the right price. But anyway, it's controversial. A lot of people like to blame the shorters for market upheaval, but I think markets sell off because markets sell off. These people are just taking advantage of it. So how does shorting work? You sell something you don't own. You can do it, and this is the way I'd recommend you do it. You do it as a paired trade. So you buy one stock, you short another stock that are in the same industry. And you can win as long as the one you bought goes down less than the one that you shorted, or the one that you bought goes up more than the one that you shorted. All right, so you're just looking at the relative. We did this in the investment society with CVS and Walgreens. So we looked at CVS and Walgreens over time, their stocks moved right together. And then suddenly they did that. They just split. And so we sold this one and bought this one. And sure enough, they came back together and we made quite a bit of money on that one. So you can do that. So what are you looking for? You're looking for two stocks like maybe Home Depot and Lowe's. They usually move together and suddenly they depart. And you think they're probably going to come back together. So you buy the cheap one and you sell the expensive one. You don't have market risk because the market could fall 50%. You don't really care. If both stocks you have fall 50%, you didn't lose anything. You had a big gain on one you shorted, you have a loss on one you have long, you still didn't lose anything. All you care about is the relative. So that's called a paired trade. Pretty popular strategy. There's a really famous hedge fund strategy called market neutral. Have you heard of market neutral before? Yeah, you've heard of hedge funds, I think, right? So there's about 10 hedge fund strategies. If I were you, before you interview for jobs, I would do a quick Wikipedia on hedge fund popular strategies. If you haven't had this in a class before, and you may never have it, there's a lot of students who don't do this, and Wikipedia might be a good place to go. So here, yeah, they got a good list right here. Global macro. Global macro is probably the most popular. We did global macro at USA. I really like, in fact, that was the first hedge fund I did. I went to the CEO and I was like, there's no way he's going to approve this. He never approves anything I bring to him. We go to his office and say, I got this strategy I really want to do. It's a Deutsche Bank hedge fund. And he literally said, yeah, whatever. I'm kind of busy today. Yeah, if you want to do that, go ahead and do that. It's the first time we've ever done anything like that. So we ran out of the office. We're never bringing it up again. Let's go get it invested before he changes his mind. Event driven, relative value. So global macro is the most popular. So relative value, that's where you get the market neutral. Relative value says, hey, these two things are real similar, but this one's trading expensive, this one's cheap. So I'm going to sell that one and buy this one. What market neutral does is leave that with your entire portfolio. Every stock they're long on, they're short on another one in the same industry. So they may be long on Exxon and short on Chevron, long on Home Depot, short on Lowe's, that kind of thing. And so why do they say market neutral? What that means is they want to be completely unrelated to the stock market. If the stock market's down 20% or up 20%, that has to have nothing to do with their performance. They should be completely neutral to the market. A beta is essentially of 0 is what they're looking for. No influence to the market whatsoever. So yeah, the first hedge fund I bought was this global macro, and I was really lucky. Usually when I do something like that, their first year is horrible. I was really lucky. They had their best year ever right after we hired them. I was like, got out of that one. So it worked really, really well, but I don't know how they've done since. I'm scared to look. So yeah, so market neutral is a very, very popular hedge fund strategy. You essentially go into every industry and you're trying to find two similar stocks that have suddenly departed from each other. Now, could you do this yourself as an investor? Yeah, you could do a market neutral strategy. You got to make sure you set up with your broker to allow you to short securities. The most challenging thing is getting it matched. Because you have a stock that's trading for $56, another stock that's trading for $80, you got to buy the same dollar amount to them, and you can't get it exactly the same. You can try your best, but it's going to be a little tough. Now with fractional shares, maybe you can get that to work out a little better. I haven't tried that with a paired trade. All right, questions on shorting. So my recommendation on shorting, do it with your paper portfolio first. Don't do it with real live money. Okay, because you can really mess up on that. Buying stocks on margin. I'm going to skip this one pretty quickly. Not that interested in it, but yeah, you don't have to, if you want to buy $100,000 or something, you don't have to spend 100,000. You can just spend 50 and put up the rest as debt, and you have to pay interest on that. It just leverages up your return. So if you put 50% down and borrow the other 50%, and it stocks up 10%, you'll just end up making 20%. It just doubles everything up. So I recommend you try some margin trades. I'm not a margin trade person. I don't really like doing that, but you can do that. It increases your risk. It magnifies every trade you do. So be real careful. But I got examples in there, but that's pretty straightforward. Okay. I want to talk a little bit about expenses in investing. And I think we got a little time we can start on this. Yeah, we can get into this. So when you invest, there's three types of expenses you're going to have as an investor. The first one's commissions, and that's the part that's essentially gone to zero. It's not entirely down to zero, but it's essentially to zero. So commissions used to be $50 in the 70s. Now it's essentially free. I don't know who you would hire that charges commissions anymore. So Robinhood, Schwab, Ameritrade, everybody's it's just free now. So that one's probably not one to worry so much about. The one you have to worry about is the bid ask. So if you're buying something, you have to pay the ask. If you're selling something, you receive the bid. The ask is higher, the bid is lower, and that's essentially the biggest thing you're going to have to pay. And they can be huge. In fact, one of the things I'll look at is the bid ask. And sometimes I've seen a bid ask which says, I'm not touching the security. That bid ask is way too wide. This is way too illiquid of a security. I'm probably getting ripped off in this trade. I'm just not going to do it. Especially on options. When I look at options, I really look at that bid ask to make sure I'm not getting ripped off. But you'll have something. Sometimes it's a few pennies. Sometimes it's a few dollars. It just depends on the security. Bid ask is where small investors get crushed. So it can be really material. So really be real careful. Watch that. The best thing you can do is take the bid minus the ask minus the bid and divide it by the stock price, and just make sure that's not like 2-3%, because you don't want to pay that kind of, it's essentially a commission. Make sure it's a really small percentage of the trade. At USA, we didn't worry so much about this. Almost all of my trades, I got the midpoint between bid and ask. So essentially to us, a small investor may be paying 50, 60 cents. We're paying, a penny or two. It's just because we had high enough volume that it didn't matter. But you as a small investor, that's probably your biggest expense of investing. And because of that, you don't want to buy a stock and turn around and sell it, because you're going to buy it higher and sell it lower, and that money's going to go to the broker. So you're just hurting yourself. Big investors have this last one, market impact. So market impact is when you want to trade 40 million or 100 million or $1 billion or $3 billion in a stock, and you put that trade out there and the market goes, wow, it's like, wow, how are we going to absorb all this? And it's going to cause the stock price to move, and it will move before you can get the trade done. So you might want to sell that stock at $50, but because you put so many shares out there, the stock falls to $49. And so you lose $1 just by putting the trade in there. Not that something fundamentally happened to the stock or they got new news, just the fact you put so much supply out there, it caused the stock price to fall. So small investors, you don't have that issue. I've never moved the market. I've never picked up the phone and moved the market on my personal side. I may have on the institutional side, but on my personal side, I've never moved the market. So small investors don't have to worry about that. Big investors have to worry about that a lot. I've had several times where we would fire a manager and hire a new manager, and it might be a $400 million portfolio. I can't just say, hey, sell all your stocks and send the 400 million over to Bob. Okay, so Mary, sell your 400 million, Mary, and send it over to Bob. Mary's at T. Rowe Price, Bob's over at Fidelity. Yeah, can you just maybe mail them a check? That's not how it works. So how do we do that? Well, the first thing I'm going to do is I'm going to look at Mary's portfolio. I'm going to look at where Bob wants to put the portfolio. I'm going to match those up. So if Mary had 10,000 shares of IBM and Bob wants 8,000 shares of IBM, what should I do? I should send those 8,000 shares to Bob and don't do any trades at all. That makes sense, doesn't it? So we start off matching everything we can match. The next thing I do is I go to the big passive investors like Vanguard or State Street, and I say, I got to put 100,000 shares of this stock out there. And they say, hey, we need 80,000. And I say, you know what? We'll give you 80,000 and we'll just trade at whatever closing price was. So we won't actually trade. We'll just swap stocks and we'll just agree at the closing price. That way you don't have to worry about moving the market. I won't move the market. We'll just do closing price. So we match those up. And then you got some left over at the end. How do you do that? Well, then you hire a transition manager. In fact, the transition manager does the first two things. And the last thing they do is they're going to take what you have to trade. They're going to look at how much volume there is, and they're going to spread that trade out over a few days to try to keep from moving the market as much as possible. So this is an entire this could be your entire career. And they're going to try to get you best execution. There's a guy that did this at Credit Suisse. He kept trying to get me to use Credit Suisse for transition management. I never did it, but I always enjoy talking to him. He's a really kind of fascinating person. And he was well known. There was a transition manager magazine. Can you imagine? You know, buy that for your aunt for her birthday. Be pretty interesting. But his picture was in that magazine almost every edition. So he was pretty well known in the industry. That was his career. He actually started as an actor in New York, and he failed as an actor, so he became a transition manager. So, you know, maybe you could go the other direction. Now he's running a hedge fund in India, but he was a transition manager. That's what he did. And the reason I never hired him, he was always like, if you hire us, we're going to save you all this money. But it was theoretical. He couldn't prove it. It was theoretical. So statistically, I think I'm saving this much money. It's like, I just don't get it. So I always use the transition manager. I always use my custodial bank because it's just a whole lot easier to do that. My custodial banks had a lot of assets, so I just felt comfortable doing that. So it's a little tricky. You don't really know the transition manager did a good job for you because they can't prove that selling the security on Tuesday was better than selling it on Monday. There's just no way to know that. But yeah, so if you're trading $1 billion, you're probably going to hire a transition manager to move that money around. So if you're hiring someone to do this, then you're going to pay your portfolio management fees. So if you hire a mutual fund, they have all of these expenses, and then they're going to charge you extra money to manage the portfolio. So if you do it yourself, you save the management fee, but then you've got to set all this up, and you get more expensive bid-ask spread and those kind of things. So the portfolio management fee, and they're going to charge you a fee based on how many assets they're holding for you. It could be a 1% fee, or like the one I bought today, 2 basis points fee, almost nothing. Some funds charge front end and exit loads. I would never hire a manager that charges a front end or exit load. That's how you know you're getting ripped off. So if they have a 7% front end load, just say, forget it. You just convinced me never to invest with you ever. So watch those carefully. And be careful. There's no evidence that higher fees mean better performance. Paying more for our discipline doesn't mean you get a better deal. In fact, the most expensive ones are probably the worst. And I don't mean they're the worst because of their fees. Even before fees, they were pretty bad. And then they charge exorbitant fees on top of that. They're really, really bad. Why? Because they're not investors, they're marketers. They're really good at marketing. They're horrible at investing. And unfortunately, they're really good at marketing. If you're a passive investor, that's about the cheapest you can go, and you start off with a huge advantage. So be careful on that. This is the easiest thing to check. You can just look it up. You'll see it. It's right there in the prospectus. If you have two funds that you think are equal in all ways, and just pick the one with the cheaper fees, and you'll probably be better off in the end. Okay, now we're going to do some cool stuff. So now we're going to get to return, and we're going to start doing some math. So we'll start getting some team questions. We'll get to a math question on the exam, talking about return. I was doing the fact exam review yesterday, and that was actually one of the questions on the fact exam. He worked it slightly different than I have it here, but I'll show it to you. So we'll start the next class.